statement of changes in equity is defined as all changes, whether increases or decreases to the owner's interest in the company during the period are reported here.
Single or sole proprietorship. An entity whose assets, liabilities, income, and expenses are centered or owned by only one person. Partnership. An entity whose assets, liabilities, income, and expenses are centered or owned by two or more persons called partners. Corporation. An entity whose assets, liabilities, income, and expenses are centered or owned by itself, being a legally separate entity from its owners. Owners are called shareholders or stockholders of the company.
Components of Statement of Changes in Equity. First, we have the heading. It composed of name of the company, name of the statement, and date of preparation. Second, increase to equity. We have the net income for the year and additional investment. And the last, decrease to equity. We also have the net loss for the year and the withdrawals by the owner.
Prepare the heading like any financial statement. The heading is made up of 3 lines. The first line contains the name of the company. The second line shows the title of the report. The third line shows the period covered. The report covers a span of time, hence we use for the year ended, for the quarter ended, and for the month ended. Some annual financial statements omit the for the year ended phrase. Capital at the beginning of the period. Report the capital balance at the beginning of the period reported, or the amount at the end of the previous period. Remember that the ending balance of the last period is the beginning balance of the current period. Add additional contributions from the owner increases capital, hence added to the capital balance. Add net income. Net income increases capital, hence it is added to the beginning capital balance. Net income is equal to all revenues minus all expenses. We can also refer to the income statement we previously prepared for the amount. Deduct owner's withdrawals made by the owner is recorded separately from contributions. You can easily find it in the adjusted trial balance as owner drawings, owner withdrawals, or any other appropriate account. Withdrawals decrease capital, hence are deducted. Increase in owner's equity is the difference of the net income and the withdrawals, which will be added to the beginning capital. Compute for the ending capital balance. Compute for the balance of the capital account at the end of the period and draw the lines. One horizontal line means that a mathematical operation has been performed. Two horizontal lines, which means double rule, are drawn below the final amount. So there you have the preparation of a statement of changes in owner's equity. It is a report that shows the items that affect the capital or equity account. Simply, we are just presenting this formula in a formal report. Capital ending equals capital beginning plus additional contributions plus net income minus withdrawals, where net income is equals to income minus expenses.
So the importance of statement of changes in equity is that users of the statement, especially the owners and the investors, can learn about the effects of the company's performance or operations and other related factors on the wealth or capital vested by them in the business. So users of the statement can also analyze how those capital or fund was utilized and the flows of such capital or equity during the reporting period. In other words, if you are an owner or a part of owner of such a business, it is important that you should learn how these transactions and factors affected by the money or capital you have put in that business. Other importance of statement of changes in equity is that statement of changes in equity helps users of financial statement to identify the factors that cause a change in the owner's equity over the accounting periods, whereas movement in shareholder reserves can be observed from the balance sheet. Statement of changes in equity discloses significant information about the equity reserve that is not presented separately elsewhere in the financial statement, which may be useful in understanding the nature of change in equity reserves.